I'm Eddie Cannell.
And I'm Tom Cannell.
Welcome, everyone. This is the Mortgage Brothers podcast show, and today we are talking about conventional loans. What are conventional loans?
Everyone mentions, conventional, conforming. Like, what is conventional? Is it like a convention happening downtown Phoenix? What does conventional mean?
I know. I remember when I got in this business and people were throwing out that, conventional, like, what is conventional about it? And, I think we, in the lending business, we make it a lot more complicated. All these, whether they're acronyms or little things that we talk about, little sayings, and, anyway, the point is we make it very complicated. And I think conventional loans, I think one of the things that people who are looking at a conventional loan, what they need to know is a conventional loan is a note, a mortgage note that is owned by Fannie Mae or Freddie Mac. And you're probably wondering, if you're listening to this, who in the heck are Fannie Mae and Freddie Mac?
Holy cow.
Brother and sister?
Well, yeah. They're like the head of the convention downtown. That's who you book the room with. Who in the world are Fannie and Freddie?
And let's just say this. The days of savings and loan companies are for the most part over. You're not going to your bank anymore and getting a loan, and if you go down the street in the old days, and I say old days, back in the 80s, at least in the 80s or prior, it's very possible you would have gone into a savings and loan company bank, and they would have given you a loan, and they would have been giving you the money from the depositors. Okay? Today, that's not happening. When you go to get a mortgage and it's a conventional loan, they're giving you the money. That's technically, yes, the depositors, but only for a couple days. What they do is they sell the note to Fannie Mae and Freddie Mac. It's publicly traded. The stocks of Fannie Mae and Freddie Mac, you can actually own a little portion of the notes. Anyway, the point is the bank doesn't own them. Wells Fargo, conventional, B of A, they don't own that note.
And the reason why they don't own that note is because they don't have enough money to own all the notes, in the country. And so Fannie and Freddie were created in order to create what we call liquidity, which is the overflow or excess in money to allow, economies and markets to trade and to sell and to purchase and to move, etc. Now, I will tell you, when we talk about, conventional and Fannie and Freddie, I think some of our borrowers will be like, whoa, I have no idea what you're talking about. So if we back up for a quick second, really, we have conforming loans, which are conventional. The opposite of that is non-conforming, something other than conventional. And I think the easiest way to tell people is there are systems set up within our economy, within our market, that basically says, if you follow these rules, we're going to give you a bonus. That bonus is basically a best-in-class low-interest rate loan. You have to adhere to A, B, C, D, E, F. If you fall in those categories and you have what we require you to have, you qualify for a conforming conventional loan. If you don't, you would go for the non-conforming, non-conventional loan known as a portfolio loan, or I think alt paper loan, whatever. There's a bunch of names out there. And I always tell, our borrowers that will call in, and, people that hear us on the podcast and whatnot, that money is boring. Money, and I'm sorry, grandpas out there, but money is like grandpas. It loves boring. It loves consistency. It does not like wild stories. It doesn't like creativity. And it rewards those people that are boring and that are consistent. The steady, income, the excellent credit scores, the, very consistent job history. It's like grandpa. He's going to reward you, and he's going to reward you by giving you a super low interest rate. So that's how I always viewed it before I got into the mortgage business, and it just kind of hopefully keeps it simple for our borrowers.
Okay, good. Okay, so conventional financing, these programs, each let's just say this, they have a limit. Like they're intended to serve the residential community. Okay, so they're for residential financing. They're not for big commercial products or big multifamily. They actually have a limit that you can 1, 2, 3, and 4. Right, up to 4 unit property, you can get conventional financing on. You can also get a home loan, a conventional on a primary residence that you live in, a vacation home, and an investment property. Conventional financing is really the only program aside from so FHA and VA are really the other popular programs, but conventional does allow investment properties. It's something that really distinguishes itself from the other programs.
So to also go off of a little bit of what we talked about, if you fall into these buckets, this money literally is some of the cheapest money you can borrow for anything. I don't care if you compare it against jewelry, if you compare it against commercial loans, if you compare it against personal loans, home equity lines of credit, you name it. This is going to be some of the cheapest money you will ever come across. And it's all because there's backing. There's that Fannie and Freddie component to it. So I had on my notes here, let borrowers know conforming conventional is the cheapest money out there. If we were, Ed, you and I were to, have a savings and loan company and just do loans ourselves, I mean, there's no way you and I would be able to offer interest rates like where they are. So again, people need to feel very rest assured that that this is a wonderful opportunity for us. I don't know what other countries do, but my guess is other countries don't have what we have.
Right. I think Canada has maybe something similar, but yeah, you're right. There's not a lot. This allows us, that liquidity. It allows the economy to just to get that money out there in these communities. And so that's what's great about conventional financing. It allows a conventional loan will go up to 95% loan to value. What that means is you just need 5% down, and in some cases just 3% down to get a conventional loan. I mean, that's amazing, right? That's another thing that we would never do. If we had a savings and loan company or any one of our listeners wanted to lend money to someone, you probably wouldn't want them to just put 3% down. I mean,
right. If your brother-in-law called you and said, "Hey, I got an idea. I'm going to go out and buy a home. Can I borrow money from you, Uncle Louie?" Uncle Louie would be like, 5% down? No, how about like 30% down?
Exactly. So there are companies. So the private mortgage insurance is what comes into play when a borrower gets a conventional loan and puts less than 20% down. So that's another part of a conventional financing. You have private mortgage insurance when you put less than 20% down.
Awesome. Well, hopefully that makes sense to everybody. I wanted to give just one more quick analogy. I was thinking about how else could investor or people understand what a conforming loan is, what is Fannie, what is Freddie, and I had this example. It's like an investor goes out there and buys a home for $400,000. He's a flipper. Or she's a flipper. Okay, buys it for $400 and wants to take it to the market and sell it for $450 and make $50. Okay, he has all this risk out there. Will it sell for $450? Who knows? Will the market go up? Will the market go down? Compare that to the conforming conventional loan where Fannie and Freddie will go to that investor and say, "Hey, we're going to buy that house from you. We're going to buy that house from you the day you purchase it, actually the day after you purchase it. But instead of you selling it to us for $450, you're going to sell it to us for $401. And you're going to go out and you're going to do a whole bunch of these in a year. So you know that when you go out and you purchase a home, we are going to buy that loan or buy that house from you." Investors would be like tripping over themselves thinking, "Holy cow, all I got to do is sell it for $1,000 over and I can do that 50 times a year or 100 times a year and make just as much money and not have any risk." She knows there is a buyer, a guaranteed buyer. So hopefully that makes a little bit of sense, but that's on the buying side on how these investors, how these lenders can keep rates so low because they know Fannie and Freddie are buying them.
That's right. Right. And just one more fun fact here, that conventional loans have a limit, right? They don't give you millions of dollars right now. Conventional loan does have a limit right now. Call your mortgage loan officer. They'll give you the limits. Okay, they'll tell you what a single-family residence, a duplex, a triplex, and a fourplex limits are.
And they'll likely adjust typically every year, not always, but typically.
Yeah.
Okay.
Right. Okay, everyone. Be sure to contact us if you have any questions. And if you like what we're doing here, be sure to subscribe, hit the notification button and the like button.
Perfect.
Take care, everyone.
Hey, thanks, folks.
Hey, guys. Thanks for listening to the Mortgage Brothers podcast. Please let us know if you have any questions you'd like us to answer. You can email your questions to team@azmortgagebrothers.com. And be sure to ask us for a free quote on your next mortgage. We'll be sure to give you personalized service and help you through the whole process. Signature Home Loans, LLC, does not provide tax, legal, or accounting advice. This material has been prepared for informational purposes only. You should consult your own tax, legal, and accounting advisors before engaging in any transaction. Signature Home Loans, NMLS 1007154, NMLS number 210917, and 1618695, Equal Housing Lender.